Hello everybody, this is the gold forecast for the week commencing the 24th of August to the 28th. So that's the week commencing 24th of August to the 28th. So I believe this is video number 15. I know I don't keep count. So let's talk about what we talked about last week, which was basically do nothing, be patient, see what price is going to do, and let's talk about what we're going to do next week. So now we can see we've got gold. This is the futures chart on the daily. So I always use the daily for forecasting. And we have kind of spent a significant amount of time above the moving SMA. So the moving SMA is what I use for simplicity. You can get complicated with this to determine the bias. Okay, so everything starts with a bias, and then we work from there. Now, in the videos, I use um, my auction levels, which are these lines right here. Now, don't worry if you don't know what these are. I will explain everything. But basically, these are, think of these like resistance levels or support levels. And we use these levels to determine entries and exits. Okay. And again, don't worry, I will explain everything. But I just want to talk about next week. So last week I said, hold off, relax, let's see what price is going to do. Now we've pretty much got enough confirmation to suggest price at least wants to carry on in the same direction, but we need to wait. What are we waiting for? So what we're waiting for is just simply for price to, again, if you're bullish and just based on the bias above this moving average, you're simply waiting for price to come back down. So you want price to come down. Where is it going down to? A auction level. Now these auction levels work pretty much the same way like PD arrays. So they're not PD arrays, but they work like PD arrays. By themselves, they are not inherently bullish or bearish. So like a PD array, they are they have a directional and non-directional bias, right? So you have to imply the bias. However, we use levels to then determine those entries or determine those exits. So what I want to see is either price break above this. So the next auction level is this red line right here. Either go there and then come back to break this level or return back to this level. So that could be a trade. Or that's one idea. The second idea is just it just goes down and then comes back down into this auction level and then to target either this one or this one. Okay, so that's the plan for next week. All right, we wait for the retracement. We do nothing. We wait for the retracement. As long as price stays above this moving average right here, then we are now weak bullish. So weak bullish just means we're transitioning to fully bullish. We need a little bit more time. What we need to see is confirmation to show us that price doesn't want to go below that line. Okay, that's when we become fully bullish. But for now, we're only looking for buys. We're not really looking for sells. That's pretty much it for next week. So now let me get into the section where for those people who are watching this video for the first time, I explain pretty much what's actually happening so everything kind of makes sense. So first of all, as a trader or as traders, we are trying to solve two problems. We are trying to understand, first of all, where does the trade take place? So think of this as a location. So where? And the second is when does the trade take place? So think of this more as implementing a model or some timing or strategy or something like that. Okay. The videos I make, the forecast videos, only deal with the first part, which is location. Where does the trade take place? So how do we do this? Now, the way I used to do it is in the olden days, I'll just draw a horizontal line, invisible line on the chart that represented multiple touch points. And I would usually use the higher time frames, meaning it daily. And what I'm looking for is using that line as a point of reference, okay, because that's where you have the most trade occur, right? The most trades occur, buyers, sellers coming together. What I've done now is simply automated that entire process, and I have a indicator that does this. I'll show it to you, but it's internal, it's not external, it's just something I use for testing. So it's called AMM, and it's all these gray lines. Now, it's a bit messy, but that's what they are. Okay. Now, this is mainly on the daily, and how this works. Now, through observation, what you'll notice over time is price is basically moving from one auction level to the next, just like a PD array. It's just moving from one auction level to the next level. That's it. So this is why I use the auction levels as the location to either enter a trade or exit an existing trade. Okay, so hopefully that kind of logic of what these lines are, these boxes, these are all auction levels. Okay, so right above us, the next auction level is this red line, which is at 4,008, say 850. So if you're bullish, that's kind of the next major level. All right, so I'm just talking about the major levels. You will have these small minor levels, but we can ignore that. And of course, below us, if we can get below this moving average, then the next, obviously, auction level is this blue line, which is right where we have this level here, which is around the 4,000 level. And then if you want to go below that, you have another one, which is 3,000, say 900, so on and so forth. So these are the levels below us. But right now we're above the moving average, so we are bullish. We're thinking buys, not sells. Now, I do want to say, if you've been watching my videos, I was very bearish before because we were below this line, and I did have a target of, well, I still do, a 2026 target at 3,500, which is this black line. Okay, and that's just a fib extension from this high to this low, extended from this high. Okay, so that's it. Hopefully not complicated. However, as I've always been mentioning, that level is very different to the levels by the professionals. So professionals like Merrill Lynch, Bank of America, Goldman Sachs, these guys have their levels at 5,000 to 6,000. So I kept warning you guys that there's a big difference between my levels and their levels. So you're aware of that. So potentially we could be going there because that's what they're paid for. They're paid to make these calls right. But I couldn't really align what I was doing with what they were doing, and I kept mentioning that. However, now that we are now above this red line, which is the moving average, we are now bullish. So now I can see there's a logic to why price might want to go to the 5,000. But the way we do it is we wait. So if we're bullish, we only buy when price comes back down into another auction level because that's price is only moving from one auction level to the next. So as you can see here is a good example. Price goes to an auction level. What does it do? It moves to the next auction level. What's it going to do again? Move to the next auction level. That's all it's going to keep doing. But we only buy when it comes down. And of course, if you are a seller for whatever reason, then you wait for price to, come down first and then go back up. So you want prices to go up to sell and you want prices to go down to buy. So hopefully that kind of explains the overall kind of logic to the process. Pretty straightforward, pretty simple. Find the location, wait for price to do its thing, and then remember you're taking the entries in or around those auction levels. Now, the other thing I do kind of want to quickly mention is that once we get to these auction levels, that's when your mindset shifts to when the trade happens. That's when you start to implement your models and strategies and stuff like that. So fair value gaps or VSA or demand and supply. That's when you do that. And I do that on the lower time frame. So any lower time frame below the daily could be any time frame, but above the 1 hour. Basically 1 hour or above. 1 hour, 2 hours, 3 hours, 4 hours, doesn't matter. You drop down to the lower time frame and then you basically look for an entry. It could be anything, a rejection, fair value gap, IFVG, or whatever it is you're looking for specifically at the location that you've identified. Okay, so if we want to be bullish, for example, let's say for whatever reason price comes back into this location, I will then go to my lower time frame, and the conservative strategy is you then wait for the move up, move down, and then you take the entry back up. Why is that? You can be aggressive, of course. So when price gets to the auction level, it can only do three things. Only three things. It can either reject or basically do a reversal. So an example is right here. You see where, well, you see this blue line is an auction level, price comes into it, and then just reverses. That's what you're always looking for, right? Of course, that has to align with your bias, right? So if you are bullish, then your expectation is price will come into the auction level and then reverse. Okay, that's what you expect to see. So you can be aggressive at the initial reversal, or just take a standard entry where you wait for some internal break of structure and then you take the entry. Okay, it doesn't really matter, depends on how you trade. The second thing the price does at these auction levels is you get a continuation. So here's an example. Price goes into this auction level here. You see how it just sort of delays a little bit, not too long, and then it moves to the next auction level. It just continues. The third thing you will see is what I call plateauing. It's it's like a consolidation or a churn or a seek and destroy. It's kind of a longer consolidation. So here's an example. You can see where price comes into this. Again, this is an old auction level. You can see we've used this auction level before. We are back into it. Price spends a lot of time just going back on, back and forth, back and forth, back and forth, and then eventually it breaks one way or the other. The problem is, again, you're not going to know which way it's going to break. You just have to wait for the break, right? So those are the only three things that it will do. And what we do is we anticipate it to reverse. That's what we're always looking for. But like I said, it can do two of those other things as well. So the cleanest trades are where it goes in. Here's another example, right? Price goes up into this auction level. Again, this is an old auction level. This is not a new one. You can see it's just reusing here. This was the auction level. If I just drag it here, you see how price has reused that same level. That's all it does. It just goes from one auction level to the next. Example where price goes into this auction level, and if you are anticipating a sell because we're below the moving average, that's your sell into the next auction level. That's really it. It's what to have a bias. So without the bias, this does not work. So the bias, you don't have to be correct with your bias. You don't have to. It doesn't have to be perfect. You just need a bias because what the bias does, it basically protects you against trading with price. If you're wrong, then you're either never going to get into the trade or you may get into a trade and just get stopped out. Okay. So for example, if I'm long, if I want to be long here, I'm never going to take a short. It doesn't matter what price does. You can have one massive down candle, I'm not taking the short. Why? Because we're above the moving average and we've got auction levels, which are basically resistance and support lines or levels where you have these interactions. They're below price. So I expect price to do one of three things: reverse, consolidate, or basically continue, or plateau. Okay, if it's going to continue, then I need price to get below this line for me to be bearish. So my bias goes from, if we look at the spectrum, so it started with bearish initially, then it goes basically to your neutral, and then it goes to weak bullish and then bullish. Okay, depending. It's usually weak bullish when it initially breaks that moving average line, right? Because you need confirmation. You need something that proves to you it doesn't want to go back to the opposite side of the line, right? So here's an example. See where price breaks this line, goes back up, right? Proves to me it doesn't want to get above, comes back, breaks the structure again. That's telling me, okay, right, I can now be fully bearish. Before that, I was weak bullish, a weak bearish. Okay, so just explaining the whole bias thing, right? Don't complicate it. I know it can get complicated using average candles and all kinds of things, but for some simplicity, I just use the moving average. That's it. If it's above it, It's bullish. If it's below it, it's bearish. That's it. Only on the daily chart, by the way, not on the lower time frame. So hopefully I've made these levels clear, like I said to you. Now this level right here, preferably is what I want price to come back to. It's the 4,000, say 450 level. But of course price can go up. If it goes up again, I'm not doing anything because I need price to come back down. So that's kind of the level below us. And then of course above us, I just said the 4,850-ish level is ultimately where we're probably going to go. And then of course we can go higher, but don't chase price. You need price to come back down. So that's it for this video. Thank you very much for watching. I'll see you in the next video.